latest edition of the Market Update and Economic Outlook. With me is Derek Varner, and today we're going to be discussing a variety of different topics. We're going to try to keep it succinct. So Derek, let's jump right in.
Sure.
Let's start off with market performance. There's been some recent actions by the Fed that's stirring markets up. Depending on what index you're following, you could say the market is up or the market is flat, or the market is down. What's your take?
Yeah, that's perfect. That's a great way to put it. So we've seen, maybe step back, we started the year with our outlook piece. For those that follow the pieces that we write, we called it the year of dispersion. What that means is we were expecting a year where different asset classes, different investments, different economies, global economies, all kind of move in different directions because of less coordinated central bank intervention. Mm-hmm. We've seen that so far this year, and in terms of what's driving markets, to answer your question more directly, a few large companies so far have pushed the S&P 500 higher. So if you're an investor in the S&P 500, which is the 500 largest U.S. companies, through the end of April, you've made about 9%. So it's a nice, healthy recovery after being down last year. But other parts of the market haven't been as fortunate. So small cap stocks, for example, smaller U.S. companies that may be may have more perceived sensitivity to the economic cycle. We would call that being cyclical. Those are closer to flat this year. Even the Dow Jones Industrial Average is actually down so far this year. So when you look through what's driving that, it's actually just a handful of large companies in the S&P 500 and the NASDAQ, like Apple, Microsoft, which are up, solidly double digits. I don't have the specific number in front of me, but when we last looked through the end of April, it was close to 30% for each company. But then also other companies that are fairly large as well, like Meta Platforms, which is the parent company of Facebook, up almost 100% in 2023. The same thing is true for NVIDIA, which is a maker of computer chips, in particular chips that focus on artificial intelligence, which has been just a big theme in the investment world this year. And so a handful of companies have driven the market higher, but there's a lot of companies that haven't participated. So we think there's still interesting value and opportunity, but we've definitely seen dispersion so far this year.
So yesterday, Chair Powell announced the Fed increased rates another quarter of a point. Based on the comments that I saw, it seems like we may be in now for a bit of a pause in between, before the next rate hike or perhaps rate decline. What are you seeing in the markets? What are the expectations?
Yeah, great question. So folks may not know this, but in the last 40 years, we've had several Federal Reserve monetary policy cycles. So what that means is the Fed, one of their main goals, they were founded after the Great Depression. One of the main goals of that institution is to try to promote economic stability. They have kind of two sub-goals of stable prices and full employment. And this year, one of their main tools in promoting those two agendas is raising and lowering interest rates. They'll raise interest rates to try to slow down economic growth, to control inflation if they feel like prices are getting out of control, and they'll lower interest rates in order to be more accommodative. So that flows through to business borrowing costs, mortgage costs, auto loans for all of us. So you can see how higher rates would slow economic activity and lower rates would promote it. The interest rate hiking cycle that we just went through, where we went through it from essentially zero during COVID, which was an environment where the Fed wanted to be very accommodative because we were very concerned about the economy through the pandemic, went from zero all the way to 5% at the fastest pace. It's the steepest interest rate increase and the fastest pace of interest rate increases we've been through in 40 years. So it was not unprecedented, but we haven't seen this level of activity in a long time. And so that had a very swift impact on securities and the economy.
Regional banks.
Regional banks. That's right. Which is a whole separate subject that we can touch on. So we just yet today's May the 4th, May 3rd, the Fed held their most recent series of meetings, and subsequent press conference was yesterday on Wednesday. They raised interest rates a quarter of a point to that, and that capped us off at 5% on the Fed funds rate. Market expectations today are that that's the last Fed rate hike we're going to see during this cycle. And in fact, the market is beginning to price in that the Fed will have to cut rates later this year and into 2024 because of what you just said. We'll talk about we're starting to see more stress in the system. We're starting to see a slowdown in growth, a slowdown in corporate earnings. We're starting to see stress in the banking system. So I think they're getting, the message that a lot of the work is done, that higher interest rates has slowed inflation, it's slowed the economy, and we probably have seen the last Fed rate hike for this cycle.
So this rate hike still came in the face of inflation numbers, or came to combat inflation numbers that said we were at around 5%. Is that right?
Yeah, year over year, the Consumer Price Index, which is published by the Bureau of Labor Statistics, it's meant to be representative of the average basket of goods for the average household. So it's things like food and shelter and energy and transportation, lots of different things that we all buy. So when you put all those things into a basket, that basket of goods in March cost 5% more than it did March in 2022.
Gotcha.
So if you think about, like, let's say you have a job and you only got a 3% raise, but everything costs 5% more, that doesn't feel good, and that has an impact on how people spend and behaviors. And so the Fed is seeing inflation is still above where they want it to be. They don't want it to be 5% every year. They want it to be closer to 2 to 3%. We had been running 8-9%. So they see inflation moving in the right trajectory down toward a more normal level, but we're not there yet. And so during the press conference yesterday, Chairman Powell, he did express confidence in the U.S. economy. He said, we think the economy is on good footing. We're not seeing significant signs of a recession, but we also think that we have a little bit more work to do in terms of making sure the inflation challenge is really thwarted.
So related to the inflation numbers, one of the things that we've been talking about in the investment committee is in particular the housing component of those of that inflation number, because it's based on what people, at least one of the pieces is based on what people expect or what they think they could get rent-wise, would cost the equivalent rent for their house. But the sales that we see of homes is declining, and so we're seeing a bit of maybe inflation. I think the conclusion that I came away with, at least, was maybe inflation isn't quite as high as 5%. If you take into account what people's expectations are versus what some of the hard data of home sales shows, maybe we are a little bit closer to 2%. And of course, the Fed knows this as well. So maybe we are really in for a break on rates.
I think you're right. I think the Fed knows that as well. And you can always be surprised. You never want to make a definite prediction, but it seems like we've experienced our last rate hike for this cycle.
So we just had a pretty strong round of corporate earnings. Earnings looked pretty good, beating expectations pretty much across all of the different sectors of the market. But what were your take on the corporate earnings?
Yeah, I'm glad you brought that up, because I think we just finished investment committee meeting, and one of the terms that was used that I think is pretty fitting for the environment we're in now is inflection point. Whether it be in the economy, whether it be in corporate earnings, it does feel like we're at a bit of an inflection point where things are starting to slow. We're maybe at sort of stall speed, and can we start to rebound from here, or are we going to continue to descend? So I think this particular earnings season was important in answering that question, because going into it, so the way earnings season usually sets up for us as folks that track this is, you go into earnings season with your expectation around what companies are going to do in terms of how they're going to perform, what earnings are going to be, and you're looking through for trends like, companies are going to say, sales are down or costs are up or, yada, yada, regulatory burden, whatever. And those things happen every earnings season. But Wall Street analysts will also put out their consensus expectations for what earnings are going to be. And the market tends to price off of that. So what I mean by that is, if analysts are expecting the S&P 500 to earn, as a group, $200 a share for that index, and then we go through earnings season and companies earn $220 per share, they outperform expectations. You typically see the market rally on that news because it's like you're earning more than you thought, so we can justify a higher share price. So we've seen that so far this earnings season, which is encouraging. So we'll share this on the screen, but as of when we're recording this, we're more than halfway through earnings season. We looked at the Russell 3000 index. So that's an index that's meant to be comprehensive of the total listed public companies in the United States. The Russell 3000 index had an earnings surprise of about 9%. So what that means is earnings were 9% higher than what was expected by Wall Street analysts. So that's good. But year over year, earnings are down slightly, flat or down. So based from Q1 2022 to Q1 2023, where earnings are pretty much flat. So we're at this point where earnings have flatlined, we're coming into earnings season, and we're outperforming expectations, which is positive. So we're not out of the woods yet, but in terms of some underlying data, which I think is helpful, consumer discretionary, which is, you, me, how we all are spending, at the store, Amazon, or we're buying cars, those sorts of things. Consumer discretionary surprised to the upside, very strong, and growth year over year was positive as well. So what you would infer from that as an economist or an asset allocator is the consumer is still spending, which is positive. Folks are still feeling comfortable, spending on discretionary items. They're not turning inward, which is nice to see.
So are there any particular asset classes that you're monitoring closely, things that you're more excited about in today's market environment?
Yeah, and this came up during investment committee that you and I just participated in. There are certain asset classes that, I think probably trade more on their perceived cyclicality than others. So more that, maybe investors, and maybe rightfully so, have more sensitivity to the economic cycle. So, companies that are typically found in value indices, companies that produce things that, maybe in a recession or a slowing economic environment, you as a consumer may delay purchasing. So for example, you don't need to buy a new car, maybe car sales slow down, during,
Yeah.
or on the small cap side, small U.S. companies just by nature of their business models and they tend to be less diversified in their revenue sources, also tend to be a little bit more economically sensitive. So when we look at value stocks, small companies, it feels like there may be opportunity in those, not only from the asset class perspective that they look attractively priced, they look fairly beaten down potentially because of concerns around, are we going to go through a recession? But small cap in particular is an area where there are just so many companies, they're so different, there's not as much coverage. We think that that's an area where the active managers that we're employing, actively selecting stocks, can add value as well. So that's one that we're pretty excited about, and then just sort of a potential for an economic recovery, lifting more value-oriented stocks in general.
So let's shift the lens on foundation premium.
Yeah.
Shift the spotlight on foundation premium. So we sent out an investor update recently, and in that update, we compared our performance to a benchmark. And I thought it would be worth highlighting something that, as part of our strategy with the fund, we we sell away the upside potential in order to buy puts, in order to buy downward protection, right? And something that you and I had talked about, but I don't think we touched on at great length in the video, or in the update at least, was that you're leaving yourself open right now to participate in some of the upside in the market rather than selling it away to protect the bottom line. So the performance may not be, I mean, if you had sold it away, the performance would be a little bit better. But we're hoping that the markets will recover in order to participate in that, which would be better than selling it off. So what are the positions that are poised in your mind? What are the positions in that fund that are poised to participate in a market upswing?
Microsoft, which is, as we started the video, that's a holding and foundation premium income, and it's a company that we love for the business model. It's a very durable business model, very diversified. You could argue that the products that they have, Excel and Office and those sorts of things, they're almost like the modern day utilities. Many people use them. They're central to doing business. And so that's a company that we added, and we thought it was undervalued. We didn't immediately sell away the upside, and then it's rallied 30% this year. And so we were able to participate in that one position. We were able to participate with the stock pretty much one for one. And then as the share price approached our price target, what we thought the company was worth, then we sell away upside.
Gotcha.
Another example in the portfolio is Intel, which is another sort of more value-oriented, more mature tech stock. That's a company, it's been under a lot of stress because they've been losing market share in the data center industry to a competitor, but they are investing so heavily in research and development, into sort of to regain leadership. And it's one of those turnaround stories that we believe in and we think will add value for shareholders, and we don't want to sell away the upside yet.
Yep.
So the nice thing about the strategy is that we can do that. We can have different structures for different positions, based on our outlook for the company. And we don't always get it right.
It's not a blanket strategy you're doing.
No, it's not. It's not a rules based. We must always sell upside. We're trying to find value, and we're trying to generate value for our shareholders.
Well, in the headlines lately, and this is a topic we have touched on in prior months, but a topic that's in the headlines now is related to the debt ceiling, the debt ceiling debate, and what will happen. And there's been a lot of voices chirping lately about when we're going to hit that ceiling, when there will be a default if the ceiling isn't lifted or isn't raised or increased. So what's your take on this topic?
The debt ceiling has been raised about 100 times since World War II. And this, up until about 15 years ago, it used to be more of a just sort of automatic part of doing business for the U.S. government. And, right or wrong, we don't get into politics but right or wrong, it's become more of a hot button debate, at the congressional level and across political parties. And we went through probably the closest environment to today was 2011. We got very, very close in 2011, I think it was August, to a technical default on our debt at the time. And what was really interesting, and we lost our AAA credit rating from S&P. We were downgraded to AA. Yep. And it was big news, of course. But if you were in the markets at the time, what was surprising, even to us that we do this every day, bonds, U.S. government debt, the market was down. The stock market was down 17%. Bonds were up 5%. So the very thing that had just been downgraded, and people, there were concerns around the U.S. government's ability and willingness to repay its debt, actually rallied because investors were looking for a safe haven. So I'm not saying that's what's going to happen again. We have this debt ceiling has a propensity to get resolved and to get pushed into the future. That's the more immediate answer. If we were to go through, to the point where the Treasury can't pay all of its bills, my understanding is that there's a a plan in place to essentially prioritize payments that begin with interest and debt, and some of the delays happen at the agency level, the contractor level, but also at the Social Security and Medicare level. Like folks, there are delays of payments for Social Security, Medicare, or if you have family members that work for the government, I believe they start delaying contributions to like pension plans and things like that. So it has an immediate potential drag on confidence, government spending, which contributes to economic growth. But yeah, and then all the broader long-term implications of, if we continue to sort of play with this fire, do we then lose our ability to borrow at a pretty low rate globally?
Yeah, and we're considered basically the world's reserve currency.
Yes.
So
yes.
The confidence, if the confidence level gets shaken too much, that could shake that
Yes,
as well.
Yep.
So as we wrap up, something that we haven't talked about at great length, but something that we're paying attention to are the tensions overseas, like in China. I mean, we're making some moves there to sort of exert our influence and strength in that region. We still have the Russia-Ukraine conflict going on. I mean, as much as our focus is on debt ceiling and the Feds, right, we have these other things going on around the globe, which could have a very real very significant impact. So as we watch those things, is there anything else that you're watching, in addition to those things? Is there anything else that you're watching, or anything else that you want to share with folks before we wrap up?
There are elements of this work that we do that are predictable, or we can use data to try to draw conclusions around where things are going to go. And there are things that aren't. So
Yeah.
like, I can't tell you what Vladimir Putin's going to do.
wish.
I just can't. Yeah, right. I don't think anyone can. But what I can look at as an investor, or somebody who's sort of studying the macro picture, I can look at incentives. I think the COVID was a big wake up. We saw all the disruption around supply chains. You saw all the, I'm sure everybody watching this remembers seeing like auto dealerships with no cars on the lot because they couldn't get enough computer chips to finish the cars.
Mm-hmm. Mm-hmm.
And all those computer chips, many of them, are made in Taiwan. And so I would imagine that we're going to see a real effort, and we've already seen this in the form of the CHIPS Act. I think it was a $50 billion spending bill to try to bring more of that production here. So those are things that we can observe and we can see and try to position for, to try to invest in or be part of. Same thing's true with, just if China's had been the kind of manufacturing hub of the world, but now we have this more tension with that other power. I would imagine that a lot of kind of manufacturing is going to come closer to the U.S. Maybe it's in the U.S., maybe it's in Mexico. Mm-hmm. So trying to participate in things like that too is how I would approach it.
Well, thank you, Derek. I really appreciate your time today. And if any of you have questions or comments, feedback on how we can better serve you, please contact us. I will put that information on the screen. You can also reach out to your wealth advisor or your CRM. Also, I want to point out we send along with this video in the email a market intelligence report. And you'll be able to see in there much more detail about most of what Derek and I talked about, as well as maybe a few other things that we didn't go into today in great detail. So just encourage you to check that out. And again, we'll welcome any feedback that you have. Thank you.